Hello and welcome to the IG Markets online seminar, Risk Management Using Orders. If you're watching the recorded version of this seminar, it was held live on Thursday, December the 10th at 2:30 in the afternoon. If it's the first of these you've watched, there's a whole range you can access direct from our website, igmarkets.co.uk, and that's where you can go to apply for an account or apply for a demo account to try out some of the stuff we're going to talk about today. Before we start, we'll just go through a risk warning very quickly. It's important to remember that CFDs are a leveraged product and can result in losses that could exceed your initial deposit. CFDs may not be suitable for everybody, so please ensure that you fully understand the risks involved. IG Markets provide an execution-only service. This presentation does not contain and should not be construed as containing investment advice or an investment recommendation or an offer of or solicitation for a transaction in any financial instrument. IG Markets accepts no responsibility for any uses that may be made of these comments and for any consequences that result. Okay, today we're talking about orders. So there are lots of different ways you can manage risk using orders and also just make your trading life a lot easier. So we're going to look at stop losses, guaranteed stop losses, trailing stop losses, and orders to open. So first of all, let's start things off by looking at some of the most basic level of risk management that we can do. For those of you who aren't clients watching this, what we're looking at here is our trading platform PureDeal. So if you're a client of ours, this is what you get access to. I've got a couple of markets I've just put in my watch list here just to keep an eye on for the purposes of today's seminar. We'll do the FTSE 100, the FTSE 100 cash contract. There's really two FTSE contracts you can trade with us. There's the FTSE 100 full value contract, and with that one, every £1 1 point move by the FTSE is a £10 move from a profit and loss point of view. Or there's this one here, the FTSE 100 mini contracts, and with the mini, every 1 point move in the FTSE is a £2 move in terms of value. So it's a fifth of the size of the full contract. So let's start off. Let's get a trade on to start off. Let's have a quick look at the charts for the FTSE and see what's been happening so far today. World indices. So with that FTSE 100, I think we've seen a bit of strength as the day has gone on today. Let's just zoom in. There's the FTSE from about 8 this morning down here. So we've seen continued strength for most of the day, pushing out to its best levels, I think, for a few days, the FTSE. There we go. We're back up to levels not seen since earlier in the week on Tuesday. So we're trading around about 52.44 now. So let's say, in our opinion, the FTSE was going to go higher from here. We were going to see some strength. So fairly obviously, we want to be a buyer. We're going to buy one contract. So for every point the market moves in my favour, on this contract is worth £2. Every point it moves against me, I'll be losing £2. What I can do though, rather than just firing that contract in first of all, what I can do here if I want to is attach a stop loss order to that contract straight away. So let's say I wanted to buy the FTSE and I was quite happy to stay in the position, but if it dips back to here, dips back below the lows of the day, it's back to 51.90, I want to be out. It's very easy to automate that level of risk control even before you've placed the trade. I think one of the misconceptions that people have of products such as contracts for difference is that you have to be stuck in front of the screen all day long, and of course you don't. If there's a market you want to buy or sell and there's a level where you want to get out, if the market doesn't go the right way, you can automate all of that and just free up your time sitting there watching the market go up 1 point, down 1 point. So we're saying we want to put our stop loss at sort of somewhere below 51.90. So the market at the moment is 52.48. So our stop loss, we reckon, needs to go about 60 points away. We can refine that once the trade is placed. We're buying £1 a point, one contract of the FTSE 100 cash mini contract. We want to stop loss 60 points away. We'll bang in our trade, click on buy. That's it. The trade is done. So we've bought FTSE 100 cash, £2 contract, buying one contract at 52.52 and a half. That's where my trade was executed. and I said put a stop loss on that 60 points away, so my stop loss has gone in at 51.92.5, and that trade is open. I can refine that and set an accurate level for the stop loss now. I said I wanted it somewhere below 51.90, so let's say we want it here, 51.86 is where we want our stop. Let's bring up Pure Deal again. If I just click on the stop level in Pure Deal and set that now at 51.86 is where I said, wasn't it? Put that in there, click on submit, that's it, my stop is edited. So now I can go off and do something far more productive instead than sitting here and watching the FTSE go up a bit, down a bit, up a bit all day long, safe in the knowledge that if the market does turn and sells off through these lows, then I will come out of that trade for a small manageable loss at 51.90. So I'm a big fan of using things like stop losses because it means, of course, you quantify your risk right from the start of the trade, and you don't have to sit around watching markets go maybe nowhere, as they have been. Sort of yesterday was a fairly quiet day in the FTSE. So if you have an objective in mind for how much risk you're willing to take, you can set all of that up right from the start of the trade. What you can also do, of course, let's say let's go back to this FTSE chart. Let's take this out a little bit. Let's say we're looking at the FTSE and we're buying it down here because we reckon over the course of the next week the market's going to go back up to here. So we think the market's going to push back up towards 53.70. So that's our objective for this trade, 53.70. If I jump back on Pure Deal, so what I can also do at this point, and I could have done it when I first brought the order ticket up, but I can also say, well, right, if the market, I'm going to click on limit here. If I click on limit, if the market gets to 53.70, I said no, I can put a limit order in there. So that way, if the market gets there, it will take profits automatically for me. So click on submit, and it's done. And you now see I've now got a value in the limit box on my open positions window. So now I've completely automated the process now for this trade. I can now, if I want to, never look at the thing again, because if the market drops to 51.86, a sell order will kick in to take me out of the trade, or if it rallies up to 53.70, then a sell order will kick in to take me out of the trade at a profit. So it frees up my time again rather than sitting here watching the screen. Of course, if I want to, if I change my mind, I can change these stops. If the market starts moving in my favor, I can edit the stop loss and move it up to, I don't know, 52.20, for example. Okay, so it's very easy to edit these things as you go along just by clicking on them in the open position window, and there's no charge for placing these sort of orders or moving them whenever I want to. And even if, if that trade, let's say I'm looking at it running back to levels that we last saw a week ago, so if it is going to go back up to 53.80, 53.70, chances are it's not going to do it today. But of course, so if I'm still in that trade tomorrow, these orders will still be in place as well. So again, it's a way of managing the risk and making sure I get out at the profit objective I want to get out at. So that's one way of doing it, very common way of doing it. Another thing you can do, let's look at Vodafone. Let's do Vodafone. So we'll do a trade on Vodafone. And we will do a trade whereby we buy 5,000 CFDs in Vodafone. So we're going to buy 5,000 Vodafone. Currently trading here, 141.25 to buy. So the size of that position is about £5,200 position is what we're going to put on here. We can put a stop loss on. Let's say we want a stop loss 10 points away. So it's going to go in at 131.25. And what we're going to do we're going to make that a guaranteed stop loss. Okay, so we're going to place a guaranteed stop loss. So this is another option you have when it comes to managing risk. So if you click on submit, that's it. That trade is now done. And you'll see there's my stop loss there. I bought Vodafone at 141.3, 5,000 CFBs, stop at 131.3, and G shows guaranteed stop loss. Now you pay a slight premium for having a guaranteed stop loss, but just to explain how they work, I don't think there are any recent examples of markets going absolutely crackers, but let me see if I can bring up an example from history. Just hold on a second and we'll have a quick look. Don't think I can on this demo version. I don't think I can bring it up. Let's just have a quick search, because I'm working on the demo platform here. So on the demo platform, because we have to pay exchange fees, we limit some of the markets that are available. So let's just bring up something like Marks and Spencer's maybe. Let's bring that one up. Marks and Spencer. And we'll bring up a chart for that. And I don't think it'll have exactly the example I'm looking for, but it'll enable me to talk through what actually happened and what we can use things like stop losses for. Let me just change this chart and tidy it up a little bit. Okay. Right. The way guaranteed stop losses can protect you. There's an example there. That one will do. Let's zoom in here on Marks and Spencer. So we're zooming in beginning of July 2008. So we're going back in time a little bit now. So let's say you bought Marks and Spencer's on this day, and you bought them at 320, for example, and it closed at 318.5. So you were slightly down on the day, but you were sensible. And when you put the trade on, you decided to place a stop loss, and you put your stop loss at £3, for example. So you bought in at 320, stop loss at £3. Of course, the London Stock Exchange closes up for business at 4:30 UK time. So after 4:30, there's no more trading, and then markets open up again in the UK at 8 o'clock the next morning. But of course, there's a whole host of things that can go on and affect share prices, even though the UK market is closed. There's what the US market's doing, what the Asian market's doing, all that sort of stuff. And of course, UK companies, make their announcements on things like their results, any director changes, all that sort of stuff from 7 o'clock in the morning. So they start announcing numbers from 7 o'clock, an hour before the market is open. So the risk is that a company can come out with surprising news and the market can't react because the market's not open. So when the market does open, you can sometimes get a fairly sharp reaction. This is what happened with Marks and Spencer's. They closed on this day here. They closed at 318.5. The next morning, I think they came out with their latest trading update, and it was worse than the market was expecting. So things weren't going that well. This of course, was last summer, just before the whole financial crisis kicked off. So it was really when the credit crunch was really gathering speed. So they closed at 318.5, came out with this bad news at 7 o'clock. Market couldn't react. So at 8 o'clock, what happens? Where are they going to open? There is no law that says a share has to open up where it closed the day before. So Marks and Spencer's bad news at 7, 8 o'clock, bang. The Marks and Spencer's share price starts trading at 268. So they closed at 318. They opened up 50p lower. Now you were being sensible and put your stop loss in at 300. Your stop loss would have been triggered because the market has dropped through it. But of course, you are not out at 300. So you're out at a much worse price than you're expecting because the market has gapped. The market's gapped through your stop on bad news. It never traded at 300. You can't be filled at 300, but your stop still kicks in. So you end up with a bigger loss than you're expecting. This is where guaranteed stop losses can come into play. So if you absolutely want to nail down the maximum risk on your trade, you can make it a guaranteed stop loss. So with a guaranteed stop loss, that is one on Vodafone. I've got a guaranteed stop at 131.3. Let's say tomorrow morning Vodafone came out with an enormous profit warning and the share price opened up at £1. I would still be out at 131.3 because I've got a guaranteed stop loss in place. So it's up to you. You have the choice there on the CFD platform as to whether you use guaranteed stop losses or normal stop losses. With guaranteed stop losses, you have that extra peace of mind. You pay a premium for it, but you have the extra peace of mind that if the market gaps through your stop, you will still be taken out at the price you're expecting. Right, so that's the risk control side of things done. Let's also talk about just using orders to make your life a lot easier. Let's pick on, what market should we pick? Let's go to over to the US markets. Let me just jump back onto our advanced charts and bring up the chart for the US markets. Let's see what's happening there. They just opened about 15 minutes ago. So we're seeing quite a bit of strength in the US. Let's look at a short-term view of the US. So this has been the US over the past 14 hours or so. So we've traded as low as just above 10,300. We've jumped up to 10,450. So let's say, looking at this market, I quite fancy doing, let's say, a short-term trade on this one. And we want to be a buyer, but we think, because it's accelerated so much in the first 15 minutes of trading, this move could be overdone. So we quite fancy being a buyer, but I'd like to buy. I reckon it may well drop down to here, 10,370. So I'd like to be a buyer, but I want to buy at 10,370. So again, I've got a choice. I can sit here and watch the market and with us it's a 24-hour market, so you may end up watching it around the clock, waiting to see if it gets back to your level, which is maybe a less than efficient use of your time. But what you can also do, if I go to the Wall Street Cash, again I'll do the $2, I'll do the mini contract here in the drop-down list, go to order to open, second one down, order to open. So what I want to do is buy, click on buy. The level I want to buy at is 10,370. The system knows it's a limit order, so I don't need to worry about what sort of order it is. The system knows it's a limit order. I want to buy one contract at 10,370. I can choose to have that order good till cancelled, which means good, it stays in place until the order is filled, or I cancel it, or I can have it good until a specific date and time in the future. If I only wanted it valid until the end of business tomorrow, I can set that up. So if it's not filled by tomorrow, it expires. What I can also do is say, right, if that order is filled, I want to have a 100-point stop loss attached to that order. For example, I can specify the stop loss ahead of the order getting filled. And I can also specify a target for the trade if it gets filled. I can say, right, if the market moves 300 points in my favor after I'm filled, take profits. So again, using orders, it's very easy to, first of all, specify levels you want to buy or sell the market at, even if you're away from the screen. And of course, most of us have real jobs we have to do, so they can't sit there and watch markets all day long. So you can specify the level you want to get into and get out at, and also manage the risk, and it just does it all for you. If I click on submit, this order will go in. There we go, it's done. And now you'll see, so it hasn't changed, of course, my open positions window. Let me just change the size of the screen. There we go. But if I click on this button here, working orders, click on working orders, it shows you what orders you've got waiting to happen. So there's my order waiting to happen. Wall Street Cash, $2 mini contract. It's working to buy one contract at 10,370 with the stop loss 100 points away if that order gets filled, and a limit order 300 points away if the order gets filled. And at the moment, that's where the market is trading now. So again, it's completely free of charge to place those orders. And if I change my mind, I can edit it. I can click on edit the order. And so actually, I want to put the order in at 10,400. Click on submit, and it will revise the order for me and make all the adjustments when that order gets filled as to where the stop and the limit goes. So there we go. It's a quick introduction to trading with orders. There's really no more to it than that. It is very straightforward, and I think it's key, I think, to trading, of course, for a couple of reasons. All importantly, to manage the risk. Trading without stop losses is, I think, a little bit crazy. But so we've got two types of stop losses you can place: normal stop losses and guaranteed stop losses. And using this facility to set up orders in the future, you can ensure that you never miss out on a trade just because you're not sat there in front of the screen. So for the recorded part of the seminar, that's the end. If I can get back to my PowerPoint presentation, that is the end. Hang on. So if you have any questions after watching this, please feel free to drop me an email. There's my email address, david.jones@igindex.co.uk. If you go to the website, if you don't have an account, you can go to the website and sign up for a demo account to play around with it. Or, of course, you can cut out the demo bit and just get involved with a real account, and you can apply directly online from the website. But for the recording, that's where we wrap things up.